What's going on, everybody? Welcome back to the Realty One Stop YouTube channel. Today, I'm going to talk to you about some REI, real estate investing vocabulary. I've compiled a list of things that I felt like I needed to learn when I began my real estate investing journey. And I wanted to kind of make a systematic list that you can follow along with to learn some of the definitions, some of the acronyms, and some of the vocab that you're going to need if you want to get into real estate investing. This will help you have informed conversations with other real estate investors and professionals. Part of being confident in what you're doing is sounding like you're confident in what you're doing. And I think learning this list will be very helpful in that endeavor. So, if you learned something from this, if you are enjoying this content, please like and subscribe. And if you have any questions about this list, if there's anything you think I'm missing, feel free to leave me a question or comment in the comment section. I appreciate any feedback you can give. If this ends up being a longer video, I may break it into a couple parts. I did have a pretty extensive list I came up with, so there may be a part two. We'll see how long it takes to get through it. Starting with number one. Oh, and again, the link to this entire definition list is going to be attached. Free Google form. Feel free to download it, take a look at it, print it out, whatever you want to do. That will be attached in the information section of this video. So feel free to check that out as well if you want to follow along. Starting with number one. REI, real estate investing. Just simply the entire business of real estate investing. You'll hear it referred to as REI in a lot of the online real estate Facebook groups or channels. Number two, buy and hold. So this is simply when you are buying an investment property with the intention to keep it long term. You may have a plan to keep it for 3 years, 5 years, or forever, but that is a buy and hold, typically a rental property. As opposed to number three, which is flips, where, as most of you probably know, you're buying and selling usually in a short term. So that's often properties that need renovations. It could refer to flipping a contract like wholesaling, which I'll talk about later. Or it could be simply you buy a property at a low price and you sell it at a higher price and you're flipping for that profit margin in between. You don't necessarily have to do the renovations, but that's a flip. All right, LTR, long-term rental. This is obviously becoming more popular in contrast to the short-term rental, which I'll explain. But a long-term rental is a traditional buy and hold rental property that you're going to put 1 year plus tenants in, right? Like a normal 12-month lease. That's a buy and hold long-term rental, LTR. Short-term rental, STR. That is something where you are planning to place tenants for less than 1 year. This would include like vacation rentals, cabins in Gatlinburg, travel nurses who are being placed for like an 8 or 12-week lease on a contract. Those are short-term rentals. Obviously, Airbnb, that's what kind of prompted this explosion of the STR market. Those are considered short-term rentals. Short-term rental arbitrage, that may be something that you've heard or have questions about, but basically that is when you are getting a corporate or a private lease with a landlord, such as myself, and you say, hey, I want to lease your apartment for $1,000 a month with the agreement that you're going to do short-term rentals out of that apartment for a higher profit margin. So maybe you pay me $1,000 a month for a lease of an apartment, but you're going to go make $5,000 a month doing Airbnb or short-term rentals. That's short-term rental arbitrage, if you hear that term. SFR is just your traditional single-family rental. SFR, single-family rental. MFR or MF, you might hear that thrown around. That's just referring to multifamily properties. Multifamily rentals, and obviously that multifamily means 2 or more units on one property. So a duplex or 1,000 units, any of those in between, that's multifamily. Commercial property. This is usually going to be defining multifamily properties with 5 or more units, but also non-residential properties. So industrial buildings, warehouses, office space, retail, malls, strip malls, those are all going to be commercial real estate as opposed to residential real estate, which is 1 to 4 units or less. Retail is another term you'll hear that is going to describe, again, storefronts, businesses, and shops that are owned or leased to businesses from investors. It also, if you hear like retail market, that's another term used oftentimes by investors or real estate agents, where they're talking about home buyers and sellers in the retail market, like single family owner occupied homes, not investment property. So you'll often hear that referred to as retail real estate. Obviously a little bit different than the other definition as retail commercial property. A note. So any type of note is basically just a promissory note to pay, a mortgage, a loan document that is going to be recorded by the county auditor against a real estate property. So that is a note, if you ever hear that term. So differences between banks, credit unions, and brokers. Okay, a bank is obviously a local, regional, or national bank chain that allows you to have checkings and savings account. They issue auto loans, mortgages, and other types of loans. The difference between that and a credit union is a credit union is owned by the members that make up the credit union itself. So, for example, when I was a police officer, we have a Cincinnati Federal Police Credit Union, okay? That means that only police officers and their families can be a member of that credit union. Having membership of that credit union allows them to have typically lower rates for loans, lower rates on mortgages, lower fees. Usually your checking and savings accounts don't have any fees. So those are some of the benefits of credit unions. Obviously, they're not all where they have like certain membership rules. There's a ton of credit unions that allow anyone to join. But there are benefits to credit unions versus banks. So understanding those differences is important. And the last thing in this piece on number 13 here is brokers. A mortgage broker is somebody who is licensed to procure loans on your behalf. So for example, I'm doing this right now with a pretty large commercial mortgage I'm obtaining. I hired a broker to go out and take all of my financials and all of the financials for the property and go out and talk to 10 or 20 different lenders to come back to me with the best rates and terms I could get for that loan. Now these brokers are paid a fee to do this, and that's going to either be part of your regular closing costs or additional closing costs to go out and secure these types of loans. So understanding the difference between a bank, a credit union, and a loan broker are important to understand those distinctions. Number 14, private lender. So a private lender is basically an individual who is willing to lend you money at set rates and terms to buy real estate. Now, they can have that type of loan secured by a mortgage on the property, by a promissory note. There's different ways that can be done, but basically a private lender is somebody who's going to give you money and you're going to pay them either monthly interest or interest on the back end of the loan plus their principal of their loan back. Number 15 is a hard money lender. The difference between a hard money lender and a private lender is that a hard money lender is typically a corporate structure, meaning it is a company that focuses on loaning out cash to investors for short periods of times. Okay? Hard money lenders are typically going to have much higher interest rates than a private lender and more fees. So for example, private money lenders that I've worked with usually have like 12% interest, right? So you're paying 1% a month in interest to that lender, plus anywhere from a 1 to 3% point, they call it, which is basically just a percentage fee in closing costs of the loan. They may have other admin fees and other things like that. But very short example, let's say I borrowed $100,000 hard money from a company. They're going to give me the $100,000 to buy a property and maybe for rehab money. And then I'm going to pay, let's say, 2 points at closing, meaning I have to pay them $2,000 up front in fees. And I'm going to be paying them 1% monthly. So every month that I have that money, I'm paying them $1,000 in interest. $1,000, right? And then at the end of the term, let's say it's 6, 9, 12 months, whatever it is, usually it's short term, then I'm going to have to pay back the entire $100,000 in principal on top of whatever interest and fees I've already paid them. Agency debt. This is a term I've heard thrown around a lot. Sometimes it's kind of confusing, but the simplest way to look at agency debt is that it is just the large uh, mortgage-backed companies that are subsidized by the federal government, like Fannie Mae and Freddie Mac. They do direct-to-consumer lending on large multifamily and commercial property. Okay, when you hear someone say agency debt, it's usually a loan that's $1 million or more on multifamily property. That's all it is. It's just a direct loan through Fannie Mae or Freddie Mac. So nothing to be, you know, nothing to be confused by. It's really a simple thing. Debt versus equity partners, number 17. A debt partner is somebody who is going to be paid interest on a deal, like a private money lender we just discussed. So that's as simple as that. They're giving you a set amount of money for a set amount of time, and you're going to pay them a set amount of interest, either monthly or at the end of the deal, whatever the structure is you set up. An equity partner is somebody who you're not going to pay interest to, but they're going to get ownership in the deal. Maybe you're going to give them 50% of the profits or 50% of the cash flow, and they're giving you X amount of money up front on a deal. That's the difference between an equity and a debt partnership. Syndications is another way people raise money for real estate. Syndication is a complicated type of discussion I can make a whole video about, but the simplest way to look at it is an SEC, Security and Exchange Commission, regulated entity that raises money from limited partners, meaning people who are just putting money in a deal, by general partners, people who are going out finding the deals and raising the money and then operating on the deal. It is a SEC filing with the SEC to regulate that structure and how you raise money, how you buy the real estate, how you disperse funds. So that is what a syndication is. Now, obviously, there's other ways to buy large apartment deals, like what I do. I partner with individual partners, and we do what's often called joint ventures, where they bring an X amount of the deal, or we have multiple partners who bring X amount of the deal, or sometimes I put in X amount of money in the deal, and we come together and buy larger deals, where then I go and operate the deal after we close. So it's a little different than a syndication model. That would be a joint venture. APR, annual percentage rate. So the annual percentage rate is often something most people understand. That's just the rate of interest you pay per year. So in the hard money lender example we used before, if you had a 12% APR, that means you're paying 1% monthly. ARM, adjustable rate mortgage. So these obviously got a huge negative rap back in the 2008, 2009 crash, because a lot of people had rate adjustments on their regular residential primary homes that went way up and caused them to foreclose. Adjustable rate mortgages are very common, especially in the commercial space. They're still used today in many deals. I have a lot of adjustable rate mortgages. It basically just says that you're going to have a percentage of interest for a set amount of time, and at a certain amount of time it's going to adjust. So like 3 years, 5 years, 7 years, 10 years. At that point, it's open to adjustment. It could potentially go down. It could go up. If rates are up, then they're going to raise higher as they adjust. And usually once it adjusts, it's only adjustable once per year. So it's not like it adjusts every month typically. A balloon payment or period is basically a deadline to pay off your mortgage. So like in these commercial notes we're just talking about with adjustable rates, usually you're going to have like a 10-year balloon. That's very common, meaning that you're going to make regular payments for the next 10 years. Your rate could adjust if that adjustment period starts. But after 10 years, you have to pay the balance of the note off, or sell the property so you can pay it off, or refinance it to a new mortgage. So that's very common in commercial real estate, and it's nothing to be confused by or scared of. It's just if you hear somebody say balloon payment or balloon period, that's what they're talking about. Amortization. This is a relatively simple concept, but it basically means the schedule of time in which your loan is going to be spread out over. Now, in the example I just gave, let's say you have a 10-year balloon. Usually your amortization schedule is still going to be 20, 25, 30 years, meaning that you're basically paying it in the manner of which it would be paid off in a longer time period than your balloon is. The reason why people do that is because if you're paying it on a 25-year amortization or a 30-year amortization, it's going to be a much lower monthly payment than if you only had a 10-year amortization. So if you hear somebody talking about amortization, it means the schedule in which the property and the mortgage would be paid in full. Now, the way amortizations typically work in real estate and with mortgages is in the beginning of the note, you're usually paying a heavy amount of interest, sometimes only interest. And as that loan goes on, after you get into year 2, 3, 4, 5, 10, 20, now the ratio shifts and you start paying a lot more principal and less interest. So they front load the interest in most mortgages, and that's what you're paying on your amortization. Now, underwriting is a pretty in-depth, complex sort of idea, but the simplest way to look at it, it's just the process of checking out all the factors around a real estate deal to determine how much income and how much expenses you might have on that property. Due diligence is kind of the next step of underwriting. So once you've kind of done your underwriting on paper, your due diligence or due diligence period in like a contract sense is when you are checking all the documents on a property, the utility expenses, the leases. You're going to do your physical inspections of a property, look for any defects that might need repairs, or you might need a credit from the seller. That's your due diligence phase, but it's basically when you're doing all your homework on a property to figure out if you want to really move forward with a purchase or not. Income, very simply, that is your gross income on a property. So all of your rents, all of your coin laundry, if you have pet fees, if you have late fees, any income you make from a property falls in that category of your gross income. Gross expenses. This is all of the cost that comes with owning the real estate. So your utilities, your vacancy rate, meaning when an apartment's empty and you're not making income, that is an expense. Insurance, you're paying for that every month or every year. Your property taxes, usually every 6 months. Your maintenance and capex, and I'll explain what the differences are between those. But all of those things together account for your expenses, including your mortgage, and that is going to determine your total expense. I'll get to why we need to understand that here in a second. Talking about expenses, maintenance. Maintenance is something that is routine in nature, okay? So clogged drains, if you have to touch up paint, if you have to, make a repair, any of those things that happen monthly, weekly, yearly, those are routine maintenance, and those are usually categorized differently than our next category, which is capital expenditures. Usually referred to as CapEx. CapEx is this money that is left over. CapEx is something that is the big ticket items where you're only going to replace them every 10, 20, 30 years, okay? So a roof, your windows, your electrical, your plumbing, even like a full remodel where you're like tearing out kitchens, bathrooms. Those are all CapEx type of things. They don't happen every year, every week, every month, okay? And those are usually calculated differently than maintenance. Cash flow. This is very simple. This is your income minus your expenses we just talked about. And usually when people refer to cash flow, they're talking about the monthly figure, right? So if you collect $1,000 a month in income and you have $800 a month in total expenses, your cash flow is $200 a month. Okay, that's something most people understand. It's pretty common knowledge, but it's important to understand it. Reserves. Reserves are something that you set aside every month that you keep in your savings or operating account in case something happens. So let's say you have extra vacancy you didn't anticipate and you need to pay the mortgage. Let's say you do have one of those big ticket CapEx items like a roof. You are putting a reserve amount in your account to keep it there in case of a rainy day. All right, NOI, net operating income, probably one of the most important real estate terms to understand. This is basically your total income of a property after all of your gross expenses have been deducted from the gross income. Okay, so that is your net income, meaning if you have, let's say you had $100,000 in income and you had $85,000 in expenses, you netted $15,000 in income. That is your net operating income. That is basically what you're going to report to the government as your profit that you'll be taxed on. ROI. This is your return on investment, and this is usually looked at as an annualized percentage. So this is going to look at the amount of money you put into a property and the amount of money you made in returns over a set period of time or over the year, and usually it's annualized. So, for example, let's say you bought a property for 100,000, you put 20,000 into it, and you were grossing 1,000 a month in income. Okay, so you're making 12,000 a month on that property, and you're into it for 120. That would be a 10% ROI, 10% return on investment. Okay. Now, if you were to, let's say, get a mortgage and cash out 75,000 of that, right? So now you have, or let's say 75,000, and you have 45,000 left in the deal, meaning money that is in the property as equity, but you did not have it returned to you, then you are going to have a much higher return on investment, because now your cash investment left in the property is, instead of being 120,000, is only 45,000. Now, cash flow is going to be calculated a little bit differently. That's going to look at the actual amount of cash you either put into a deal or have left in the deal divided by your monthly cash flow. Now, you can look at it as an annualized number or a monthly number. It doesn't really matter. But for example, let's say you bought a property with cash for $100,000, and you are cash flowing in profit $833 every month. Annualized, that's going to be $10,000 a month in net operating income. On a cash on cash return, that would be calculated at a 10% cash on cash return. Okay, so whether you have debt service or not is irrelevant. Whether you have a mortgage, you're looking at your actual profit divided by the amount of money you have in the deal. That's going to give you a cash on cash percentage of return. It's a little bit different than a regular ROI, because a regular ROI is going to be looked at as a total over a period of time that's annualized, but it also factors in the cash you put into it, your cash flow, and any equity you're getting out of the property. And the last one I'm going to cover today is IRR. Okay, IRR is what is called an internal rate of return. This is the most complex and complete picture that investors use to evaluate properties, but this is going to calculate all the factors, all the monetary benefits of real estate investing. So this is going to have your cash on cash return, your tax saving annually from a depreciation, your tax savings if you were to do like a cost segregation study, which I can cover later. And not only that, but you're actually going to come up with a appreciation estimate, meaning that if I say I'm going to appreciate in value by 2% over the next 5 years, that increase in value is used to estimate an internal rate of return when you're looking at a property. So this is a little bit more complicated. It's not really used by all investors because some of it's speculatory. But if you want to do an IRR underwriting study, you're going to get the most complete picture of the profitability of a property. And it looks at every facet of real estate. All right, guys, I have a bunch more to cover, but I don't want to, have this video run all day. So if you learned something from this, please like and follow, share it with somebody who may gain something from it. If you're enjoying the Realty One Stop YouTube channel, please subscribe. And if you have any questions or comments, if there's something that you wanted covered that I missed, please leave me a comment. I'm happy to make a video response. And I have another 30 terms or so that I'm going to cover in a part 2 video. So I appreciate you sticking around to the end. I hope you learned something, and I'll see you next time, Realty One Stop YouTube channel. Thanks.